So let's get started with our IND AS 16 Property, Plant and Equipment All Questions Discussion Series. Question number 1. On 1st April 2017, an item of property, plant and equipment is offered for sale at 1 crore with payment terms being 3 equal installments of 33 lakh 33,333 over a 2-year period. So this is the date of purchase and this is the sale value, but we are going to get it over a 2-year period with this being the equal installment payment. So how much are we getting? They are telling that this is the installment, so 33333 into 3, so that comes about to it comes about to 99 lakh 99,999. Okay, but that is not how we are going to record. There is something called as a time value involved, which we already know, and they are telling that is going to be over a 2-year period, which means the first installment is going to be paid on 1st April 2000 X1 itself, and the second and third is going to be paid on 31st March 2000 X2 and 31st March 2000 X3. So like this only they are going to pay. So, and they are given that the implicit interest rate at 5.36 percentage per annum. What is the necessary journal entry also for this regard? Right now we will quote the principle as given in IND AS 16, which is that when the payment is deferred beyond a normal credit term, so here it is going to be spread over a period of 2 years, right? Let me slightly change the color. Here it is going to be spread over a period of 2 years, right? So in that case, how we are going to record the payment is that the asset is recorded at its cash price equivalent on the recognition date. So equivalent to the cash price on the recognition date, which means the we will discount it and we will record it. And whatever the pay difference between the total deferred payment and the cash price equivalent is treated as an interest expense over the period, right? Now let us go about finding it. So how are we going to record? We are going to record it at the cash price equivalent. Come on, pen, what happened to you? Yeah, we're going to record it at the cash price. Clear? Now, this first installment we are going to pay it on 1st April 2000 X1. So here the discounting factor is 1. Right, the discounting factor is 1, so here it is 33 lakh 33 and 333. Then we are given the interest implicit rate at 5.36 percentage per annum. So we are finding the discount rate. How will we find? 1 divided by 1.0536, so it comes to 0.949. We will take it as 4 decimal point. If they are given, we will take it as it is. Here they are, the suggested as given at 3, so we are taking 3. Right, next on 31st March 2003, the final 33 lakh 33,333, and they rounded to 34, so that we'll get 1 crore, right? So equal. So one more time, if you put 1 divided by 1.0534, we are 36, we are getting 0.91, sorry, 9008, rounded off to 0.901. So when we discount, we are getting the cash price equivalent as 95 lakh. So this will be the value at which the asset will be recorded at the initial date. So 95 lakh. All right. So how are we going to record it first? But before that, let us also prepare the loan amortization table. So on 1st April 2000 X1, how we do that as that opening interest minus installment equal to closing. Okay, opening plus interest minus installment equal to closing, and this interest minus installment is the principal amount that will be repaid. So either you can put opening minus principal repayment, that is closing, right? So we will do it as opening plus interest minus the installment, that is the closing value. So here the opening is 95 lakh, which is the cash price equivalent. Interest we did not have because that is the initial date, and the installment that is repaid is 33 33 333, and the principal amount is also the same thing because that we do not have the interest, and this is the closing value. Similarly, for the end of the year, so the next second installment, it comes to 61 lakh 66,667, and here the interest is 5.36 percentage, so we will add the interest. So 61,66,667 into 5.36 percentage, so it comes to 3,30,533, and then we will deduct the installment, so that will give us our closing. Then we will bring it to here. So what is the remaining that we have? 3163 867. Interest of 5.36 percentage, it gives to 1,69,583, and minus 33,33,333, it gives a principal. I mean, if you deduct that, will get the principal rebate, but here we'll get the closing balance as nil, zero. We will get that. So this is about the loan amortization table. Now let us see how the journal is going to be presented. So we told that the asset will be recognized at the cash price equivalent. So the cash price equivalent here we have found it as 95 lakh. So property, plant and equipment accounted at 95 lakh. So what is the first payment that we are making? We are making a payment of 33 lakh 33,333. So that is a to cash or to bank, it goes out. Next, to accounts payable, whatever is remaining, it's still remaining as payable, that is 6166 667. That is about it. Now with regard to the interest accrual journal entries, so here we found that the interest expenses 3 lakh 3533, so we will write that up. And for the next installment that is we are paying is this is what we are paying, or we can write it as this is the interest expense, this is what we are paying, and the balance will be reduced from the accounts payable, which is reducing the principal amount that is payable. Similarly, we can do it for 31/3 2000 X3 also, and that is the end of the question. So the point here is that whenever the payment is deferred beyond the normal credit terms, it will be recognized at the cash price equivalent to that, and the difference will be recognized as the interest. Difference between the total deferred payment and the cash price will be recognized as the interest over. So this is the interest that we are having. Clear? That is about question number 1 done and dusted. Moving on to question number 2. Here they are given Pluto owns land and building which are carried in the balance sheet at the aggregate carrying amount of 10 million. So this land and building in the books they are shown at 10 million, but their fair value is 15 million. So this is the fair value. Okay, the fair value is 15 million. Now the company exchanges this land and building, so they are giving this, and what they are getting is they are getting a private jet worth rupees okay, the private jet fair value is 20 million. Okay, and they are also paying a cash of 3 million. Now let us say what is the journal entry with regard to this. So we are giving up a non-monetary asset to buy an asset. Okay, so what we are giving up is a non-monetary asset. Right, in this case the value of the asset that we get should be recorded at the fair value of asset given up. Okay, fair value of the asset given up only we should be recording. So here when this item of property, plant and equipment is exchanged for another non-monetary asset, and the cost of the asset acquired, so the asset acquired is the private jet, is to be measured as the fair value of the asset that is given up, provided this transaction is having commercial substance there. So provided there is commercial substance, and it can be, cost can be measured reliably. So there should be commercial substance, means there should be some need for this transaction, not just giving getting, not just a simple exchange transaction, but there should be some need for that, right? And there should be some commercial substance, and cost must be reliably measured. So if both these things are there, then we can measure it up in this way. So what we told, the fair value of the asset given up would be it. So here the fair value is 15 million, but alongside that we also paid cash, which is 3 million. So the total value at which the private jet would be recognized is 18 million. Clear? So 18 million is the value for the private jet. Now let us see how we are going to record the journal for this. So fair value of the asset given up 15 plus we are going also giving cash. So 15 plus 3 is 18. Clear? So that is what comes in, asset comes in, that is a private jet which comes in. Now what goes out? Cash goes out of 3 million. Cash goes out. Now derecognition of the old land and building at its carrying amount. So carrying amount, what is that? That we will take it out from the book. So for that we are crediting it, and that will be at the carrying amount, which is 10 million, and the difference whatever is there is going to be the profit on the exchange of the asset. If you see, this profit on the exchange of an asset is nothing but the difference between the fair value minus the carrying value, okay, which is 15 minus 10, which is 5 million. So this difference is what we are also having here as the profit on exchange. I hope this point is crystal clear. Now, so that is the point, main crux about this question number 2. Question number 2 done and dusted. Moving on to the next one, question number 3. Alright. Jupiter Limited has an item of property, plant and equipment with original cost of 1 lakh, and the accumulated depreciation is 55,000, and the fair value on the revaluation date is 65,000. So what they are given the cost is 1 lakh and the accumulated depreciation is 55,000. So what is the value of it? 1 lakh minus 55,000 comes to about 45,000 is what the value we have now, and the revaluation value is 65,000, which means the gain that we have is 20,000. So this is what we are required to do. Right. So, so the revaluation surplus is 20,000. Okay. But we have two methods to approach this. One is called as a depreciation elimination method. So the name itself suggests that depreciation is going to be eliminated. So the accumulated depreciation, we are going to remove it. So that is what we did here also. So we are taking off the accumulated depreciation, which means we are left with the value of 45,000, and from 45,000 it is going to 65,000. So we are having a revaluation surplus of 20,000. So how do we write it? The value of the asset increases, which means asset accounted R2, revaluation reserve 20,000, it is increasing. So this is about the depreciation elimination method. Now going to the next method. This is called as a restatement method, which means the depreciation will not be eliminated. Everything will be there as it is. But we should see by what percentage the change is occurring. Clear? So what did we see was a gain there? The gain there was 20,000. Okay. From and the carrying value is 45,000. So there's going to be an increase of 20,000 from 45,000, right? So what is the percentage change? 20,000 divided by 45,000. So we are having a change of about 44.44 percentage is a change that we have, right? This is a restatement approach, which means both the gross cost and accumulated depreciation are restated proportionately. Okay, so let us restate the gross cost. What is the gross cost? 1 lakh. 1 lakh is what we have, right? And accumulated depreciation of 55,000 we had. Clear? Okay, so this there's going to be a jump of 44.44 percentage. So 1 lakh plus 44.44 percentage gives off okay, 4444 is what we had, but what they're done, 444 44.44, but it was like 4444. So let's also take it like that. 1 lakh plus 44.4444 percentage. So there's a jump of about from here it goes to 1 lakh 44,444. Clear? And there's also going to be a jump for the accumulated depreciation. So 55,000 plus 44.44 percentage, that jumps to 79,442. Now let us also see by how much the jump is there from 55. There's a jump of uh, 24,442. Okay, so here they have done some rounding off and all, but this is the exact amount. Now 1 lakh minus 55, it is 45,000 here. So here also there is going to be a jump of 44%, which means from 45,000 plus 44.444%. percentage, there's going to be a jump of 64,998. So which means the difference is about 20,000, okay, rounded off. So this is the difference, clear? So this is what is happening. So we are not removing the depreciation is not eliminated, rather that everything is being restated by how much percentage the difference is going to happen. This is the plain overview with that. Now let us see how the journal is going to be presented. So we know that the revaluation surplus is going to be raised by 20,000, and the cost of the asset is going to be increased by 44,444, and the accumulated depreciation is also going to be increased by 24,442 or 444. Clear? So this is about question number 2. We saw about two methods. One is about the depreciation elimination and the other is about the restatement method. Fine. So that brings us to the end of question number 3. Moving on to question number 4. Right. Venus Limited is a large manufacturing group. It owns industrial building and office building. Now the management is telling they want to do revaluation model for the office building. So here they want to do revaluation model, and here for the industrial building they want to do cost model. Can they do so is the question here, right? So point is that it is building, so should there not be the same method of valuation that is to be followed? No, it is not like that. So we have two people, no? We have Rohit Sharma, then we have our favorite Ishan Sharma. Okay. So, just because they have the same surname doesn't mean that they are brothers, right? So, just like that, just because we have building, it doesn't mean it's the same thing. We'll have to see what is the nature of the asset. We'll have to see what is the use, what is the purpose for it is being used. Only then we can tell if it is the same class of asset. Clear? Let's read through the provision. IND AS 16 permits an entity to choose either cost model they can choose, or they can choose a revaluation model, either of it. Whereas in investment, we can only choose the cost model. Okay, for subsequent measurement of the property, plant and equipment. But however, if once a model is chosen, it have to be applied for that entire class of asset. They are telling only about the class of asset. Okay, when we tell class, it means a grouping based on the nature and how it is used. Okay, now land, building, plant and machinery, motor vehicle, office equipment, all these are different classes of asset. Now if you see about the industrial building, we can tell it is factory, warehouse, these are all industrial building. So it could be in the industrial zone, it could be for manufacturing or for storage purposes. And if we talk about the office building, it is like a administrative, it is for administrative purpose only. So that is only for office building. It could be located in the central business district, whereas the industry, they should be located in that particular designated area, if at all it is mentioned like that. So here, can we have two different model applied? Yes, very well possible, because they have different nature and different use for the same. So for the office building, you can use a revaluation model. Yes, but office building one in one location, office building two in another location, another office building. So for all these office building, we'll have to follow the same revaluation model only. Now, for industrial building, yes, you can use a cost model, but industry, factory 1, factory 2, factory 3, for all these things, you will have to follow what we call as only the cost model only. Clear? So this is the point with regard to this. Now, IND AS 16 does not permit selective revaluation only for some asset within the class. So I cannot tell for here this office building 1 I will use cost, and for others I will use revaluation. So that is not possible. So inside a separate class, you cannot have distinct or different type of revaluation methods being followed. So that is a point about it. So also the disclosure requirement as per IND AS 16 is that you will have to disclose what method of valuation you are going to, sorry, what method of valuation you are using for each class of asset. So we'll also disclose office building revaluation model, industrial building cost model, like that we will disclose also. Now the conclusion is that yes, we can apply the revaluation model to that to that entire class of asset. Hold on, let me slightly zoom in. So yes, we can use that revaluation model for that entire class of asset, provided that for that same class the same model is being followed. Okay, so if at all you are using revaluation model for the office building and cost model for the industrial building, it is all right, you are in compliant with IND AS 16(1)(d). Now moving on to the next question. Illustration 5, utilization of the revaluation surplus. So there is a property, plant and equipment which was purchased for 9 lakh, and the estimated useful life is 10 years and the depreciation is straight in value method on 1/4/2000 which is after 2 years. Come on pen, right? After 2 years. It is being changed to 9,60,000. So what is the point in here? What is the depreciation and everything they are asking? Now the original cost is 9 lakh and the estimated useful life is 10 years. Do we have a residual value here? No. So 9 lakh divided by 10. So 90,000 is the depreciation that we have. So this depreciation is going to be there for 2 years, right? So 9 lakh minus 90,000 minus 90,000. So the value at the end of the second year is going to be 7 lakh 20,000. So at the end of the second year, so after, so depreciation will be charged on 31/3 2000 x3, right? On 1/4 x3, so next date only it is becoming 9 lakh 60,000. So there's a revaluation surplus of 2,40,000. Clear? Right? So this 2,40,000 is a revaluation surplus. Now, the useful life remains unchanged, they have given. So which means from, I'm sorry. So useful life remains unchanged. So how many remaining years of useful life we have? We have 8 years. So from the third year onwards, what is the depreciation for us? 9 lakh 60,000 divided by 8, which means 1,20,000 is the depreciation that we are going to be charging from now on, which means previously we had 90,000 of depreciation. So from now on, there's going to be an increase of 30,000 depreciation that is going to be charged. So this 30,000, that we will be doing, sorry, what we will be doing is that we will be reducing it from our revaluation surplus and we will be transferring it to our retained earnings. So that is a point that we are testing in here. Additional depreciation attributable to revaluation. Okay, only this is because that we are increase the value due to revaluation. So because of that we are increasing the value. This will be transferred from revaluation surplus to the retained earnings, which will reduce the revaluation surplus, and that amount we will post it to the retained earnings. So this is the point in here, right? And after doing it for the first year, the closing balance in the revaluation surplus will be 2,10,000. This is where the question ends for us. Now, illustration 6. An asset was purchased for 10,000. The asset was initially estimated to have a useful life of 10 years and the residual value is 2,000. So 10,000 is the value and the residual value is 2,000. Useful life is 10 years. So what is the depreciation? 10,000 minus 2,000 divided by 10. 800 is the depreciation that we have at the end of 2 years. So for 2 years we are going to charge this 10,000 minus 800 minus 800. So the carrying amount will be 8,400. Okay, so after that it is being revised to 4 years. So here also depreciation is 800, here also depreciation is 800. Now the value is 8,400 at the beginning of the third year, but the useful life is going to be only 4. Now let us calculate the depreciation. Always do not forget to deduct the residual value from this. So 8,400 minus 2,000 divided by 4. 1,600 is going to be the depreciation from now on. Just a very simple problem. But anyway, we will do just because they are given it for us, right? Yeah, the crux of this question lies in here. Where there is a revision of the useful life, it is treated as a change in the accounting estimate. Okay, revision of useful life or change in method of depreciation, all are going to be treated as a change in accounting estimate only. So there is nothing like retrospective. We are going to do the changes only prospective from then on. Okay, so no retrospective adjustment is made. Depreciation is revised prospectively from the date of change. Clear? That is about question number 6. Now moving on to question number 7. An entity acquired an asset 3 years ago at the cost of 50 lakh. The depreciation method adopted is 10% of the reducing balance method. At the end of year 3, the remaining useful life is 8 years and the depreciation is changed from reducing balance to straight line method. Okay, very nice. So here also again what they are doing, they are changing the method of depreciation. Okay, so which means again this is also going to be only a change in the accounting estimate, and it's going to be accounted for prospectively, not retrospectively, right? So that they are given and accounted for prospectively. So let us do the calculation. So it was acquired 3 years ago for a 50 lakh. So 10% reducing balance method. So 10% 50 lakh, 5 lakh if we deduct 4 lakh 50,000. Then 4 lakh 50,000 if we deduct 10%, it is 40 lakh 50,000. 40 lakh 50,000 if we deduct 10%, it is 36 lakh 45,000. So we are freezing it till here. Now what is happening is that from now on we are going to change it to straight line method. So which means the same depreciation for every year. So 36 lakh 45,000 is the carrying amount now. So this we are going to divide by 8, and from now on the depreciation per year is going to be 4 lakh 55 625. This is the depreciation that we are going to have. So that's all they have presented it, like what is the depreciation for every year. Okay, so there is nothing like transfer to revaluation because there is no additional depreciation, and also it is not due to the revaluation. So only if there is an additional depreciation that is going to be charged owing to the revaluation of the asset, then that is going to be transferred to the revaluation reserve. Now my very personal favorite, illustration 8, replacement of a major component. So there is this heavy machinery. MS Limited acquired a heavy machinery at a cost of 1 crore. Okay, the no separate cost of the component part was available. But the estimated useful life of this entire machinery is 10 lakh and the depreciation is charged in the straight line value method. At the end of the 6th year, one of the major component, namely the turbine, requires replacement for the further maintenance and has become uneconomical. Okay, so the end of the 6th year, we are replacing a turbine at a cost of 45 lakh. Okay, this is at the end of the 6th year. So 6th year the cost is 45 lakh. Beginning, what is the cost? We don't know. We will have to arrive at it. But before that, let us see some of the theory part in that. So IND AS 16 tells that whenever a major component is to be replaced, okay, and we are able to have future economic benefit, and the cost can be easily measured. So benefit is there and the cost can be easily measured also. Then the cost of the new turbine will be capitalized, okay, and the old turbine will be de-recognized, and we will also do component accounting for that. So that is a point in here. So what is it, what they're telling? So it is future economic benefit we are going to get, and cost can be measured easily. So here they are not telling about any benefit in the question, but the cost can be measured easily. So we will assume that the benefit is also flowing to us. So we will put a tick for that and go about recognizing, that is capitalizing this cost, and de-recognizing the older cost. Okay, but the problem is that we know the value of it only at the 6th year. We do not know the initial value. and they have given a discount rate. So at the end of sixth year, the value is 45 lakh. And what is the value of it at the beginning, right? So we will discount and find it. So 1 divided by 1.05, 1, 2, 3, 4, 5, 6. 1 divided by 1.05, 1, 4, 5, 6. So 0.7462 into 45 lakh. So the value offered at the beginning of the first year is we are getting as 33,57,969. So this is the value offered at the beginning of the first year. So they have rounded off. Okay. So they have rounded off to 33,59,900, but suppose the same thing, right? So sixth year, we know that the value is 45 lakh. Okay, and the first year, if we find that its value is 30, yes, pen, 33,57,900. Okay, so this is included in the value of 1 crore. Now let us find the depreciation, find the carrying amount of it. So 1 crore, if you are depreciating, the value of it is coming to be 40 lakh. I'll do it in here. The entire machine, 1 crore, and this turbine is 33,57,900. Okay, this is the value of it on year 1, day 1. So let us find the value of it on the end of 6th year. Okay, so if we depreciate this 1 crore for 6 years, we'll get about the value of 10 lakh. Yeah, simple math. Then this value at the end of the sixth year, how will we find that? So we know that the value of the entire thing is 10 years only. Okay, so that also 10 years only. So 33,57,900 divided by 10. So for 1 year, the depreciation is 33,5790, and for 6 years, the depreciation is going to be 20 lakh 14,740. And now, if we arrive at the carrying value, it is going to be 13 lakh 43,160. This is included in this. Our objective is to remove this and add the value of the new turbine. Okay, so 40 lakh minus 13,43,160 plus 45. So the value is what we have is 71,56,840. Clear? So I will sum it up one more time. So we know the value of the turbine at the end of the sixth year, which is 45 lakh. And at the beginning it was 33,57,900. This is included in 1 crore. Let us go about depreciating and arriving at the carrying value at the sixth year. Then what we do, we find what is the carrying value of both of it at the end of the sixth year. The carrying value of the machinery is 40 lakh, and this carrying value is 13 lakh 43 160. So we are removing that and we are adding the new value of the turbine. Then our revised carrying amount is 71,56,840. So let us see how the journal is being presented. New turbine comes in, so at 45 lakh. So new turbine is coming in. Old turbine de-recognized. Okay, and what we are paying in cash for this 45 lakhs. So new machinery coming in, cash goes out. This one de-recognized and loss on de-recognition. So this is how the journal entry is presented. Very easy. Let's take a pass till here. We will continue and see in the next video. Thank you all. Stay tuned. Bye.